Chapter 17. Money and the Banking System. A system established largely to prevent bank panics produced the most severe banking panic in American history. Milton Friedman. Money is of interest to most people, but why should banking be of interest to anyone who is not a banker? Both money and banking play crucial roles in promoting the production of goods and services, on which everyone's standard of living depends, and they are crucial factors in the ability of the economy as a whole to maintain full employment of its people and resources. While money is not wealth, otherwise the government could make us all twice as rich by simply printing twice as much money, a well-designed and well-maintained monetary system facilitates the production and distribution of wealth. The banking system plays a vital role in that process because of the vast amounts of real resources, raw materials, machines, labor, which are transferred by the use of money, and whose allocation is affected by the huge sums of money, trillions of dollars, that pass through the banking system. American banks had $14 trillion in assets in 2012, for example. One way to visualize such a vast sum is that 1 trillion seconds ago, no one on this planet could read or write. Neither the Roman Empire nor the ancient Chinese dynasties had yet been formed, and our ancestors lived in caves. The role of money. Many economies in the distant past, functioned without money. People simply bartered their products and labor with one another. But these have usually been small, uncomplicated economies with relatively few things to trade, because most people provided themselves with food, shelter, and clothing, while trading with others for a limited range of implements, amenities, or luxuries. Barter is awkward. If you produce chairs and want some apples, you certainly are not likely to trade one chair for one apple, and you may not want enough apples to add up to the value of a chair. But if chairs and apples can both be exchanged for some third thing that can be subdivided into very small units, then more trades can take place using that intermediary means of exchange, benefiting both chair makers and apple growers as well as everyone else. All that people have to do is agree on what will be used as an intermediary means of exchange, and that means of exchange becomes money. Some societies have used seashells as money. Others have used gold or silver, and still others have used special pieces of paper printed by their governments. In colonial America, where hard currency was in short supply, warehouse receipts for tobacco circulated as money. In the early colonial era in British West Africa, bottles and cases of gin were sometimes used as money, often passing from hand to hand for years without being consumed. In a prisoner of war camp during the Second World War, cigarettes from Red Cross packages were used as money among the prisoners, producing economic phenomena long associated with money, such as interest rates and Gresham's law. Footnote: Gresham's law is that bad money drives good money out of circulation. In the POW camp, the least popular brands of cigarettes circulated as money, while the most popular brands were smoked. End footnote. During the early, desperate, and economically chaotic days of the Soviet Union, goods such as flour, grain, and salt gradually assumed the role of money, according to 2 Soviet economists who studied that era, and salt or baked bread could be used to buy virtually anything a person might need. In the Pacific islands of Yap, a part of Micronesia, donut-shaped rocks function as money, even though the largest of these rocks are 12 feet in diameter and obviously cannot circulate physically. What circulates is the ownership of these rocks, so that this primitive system of money functions in this respect like the most modern systems today, in which ownership of money can change instantaneously by electronic transfers without any physical movement of currency or coins. What made all these different things money was that people would accept them in payment for the goods and services which actually constituted real wealth. Money is equivalent to wealth for an individual only because other individuals will supply the real goods and services desired in exchange for that money. But from the standpoint of the national economy as a whole, money is not wealth. It is just an artifact used to transfer wealth or to give people incentives to produce wealth. While money facilitates the production of real wealth, greases the wheels, as it were, that is not to say that its role is inconsequential. Wheels work much better when they are greased. When a monetary system breaks down for one reason or another, and people are forced to resort to barter, the clumsiness of that method quickly becomes apparent to all. In 2002, for example, the monetary system in Argentina broke down, leading to a decline in economic activity and a resort to barter clubs called truque. This week, the bartering club pooled its resources to buy 220 pounds of bread from a local baker in exchange for half a ton of firewood the club had acquired in previous trades. The baker used the wood to fire his oven. The affluent neighborhood of Palermo hosts a swanky truque at which antique china might be traded for cuts of prime Argentine beef. Although money itself is not wealth, an absence of a well-functioning monetary system can cause losses of real wealth when transactions are reduced to the crude level of barter. Argentina is not the only country to revert to barter or other expedients when the monetary system broke down. During the Great Depression of the 1930s, when the money supply contracted drastically, there were in the United States an estimated 150 barter and/or scrip systems in operation in 30 states. Usually everyone seems to want money, but there have been particular times in particular countries when no one wanted money because they considered it worthless. In reality, it was the fact that no one would accept money that made it worthless. When you can't buy anything with money, it becomes just useless pieces of paper or useless little metal discs. In France, during the 1790s, a desperate government passed a law prescribing the death penalty for anyone who refused to sell in exchange for money. What all this suggests is that the mere fact that the government prints money does not mean it will automatically be accepted by people and actually function as money. We therefore need to understand how money functions, if only to avoid reaching the point where it malfunctions. Two of its most important malfunctions are inflation and deflation. Inflation. Inflation is a general rise in prices. The national price level rises for the same reason that prices of particular goods and services rise, namely that there is more demanded than supplied at a given price. When people have more money, they tend to spend more. Without a corresponding increase in the volume of output, the prices of existing goods and services simply rise because the quantity demanded exceeds the quantity supplied at current prices, and either people bid against each other during the shortage, or sellers realize the increased demand for their products at existing prices and raise their prices accordingly. Whatever the money consists of, seashells, gold, or whatever, more of it in the national economy means higher prices, unless there is a correspondingly larger supply of goods and services. This relationship between the total amount of money and the general price level has been seen for centuries. When Alexander the Great began spending the captured treasures of the Persians, prices rose in Greece. Similarly, when the Spaniards removed vast amounts of gold from their colonies in the Western Hemisphere, price levels rose not only in Spain, but across Europe, because the Spaniards used much of their wealth to buy imports from other European countries. Sending their gold to those countries to pay for these purchases added to the total money supply across the continent. None of this is hard to understand. Complications and confusion come in when we start thinking about such mystical and fallacious things as the intrinsic value of money, or believe that gold somehow backs up our money or in some mysterious way gives it value. For much of history, gold has been used as money by many countries. Sometimes the gold was used directly in coins, or for large purchases in nuggets, gold bars, or other forms. Even more convenient for carrying around were pieces of paper money printed by the government that were redeemable in gold whenever you wanted it redeemed. It was not only more convenient to carry around paper money, it was also safer than carrying large sums of money as metal that jingled in your pockets or was conspicuous in bags, attracting the attention of criminals. The big problem with money created by the government is that those who run the government always face the temptation to create more money and spend it. Whether among ancient kings or modern politicians, this has happened again and again over the centuries, leading to inflation and the many economic and social problems that follow from inflation. For this reason, many countries have preferred using gold, silver, or some other material that is inherently limited in supply as money. It is a way of depriving governments of the power to expand the money supply to inflationary levels. Gold has long been considered ideal for this purpose, since the supply of gold in the world usually cannot be increased rapidly. When paper money is convertible into gold, whenever the individual chooses to do so, then the money is said to be backed up by gold. This expression is misleading only if we imagine that the value of the gold is somehow transferred to the paper money, when in fact the real point is that the gold simply limits the amount of paper money that can be issued. The American dollar was once redeemable in gold on demand, but that was ended back in 1933. Since then, the United States has simply had paper money, limited in supply only by what officials thought they could or could not get away with politically. Many economists have pointed out what a dangerous power this gives to government officials. John Maynard Keynes, for example, wrote, "By a continuing process of inflation, governments can confiscate, secretly and unobserved, an important part of the wealth of their citizens." As an example of the cumulative effects of inflation, in 2013, Investors Business Daily pointed out that in 1960, you could buy 6 times more stuff for $1 than you could buy today. Among other things, this means that people who saved money in 1960 had more than 4/5 of its value silently stolen from them. Sobering as such inflation may be in the United States, it pales alongside levels of inflation reached in some other countries. Double-digit inflation during a given year in the United States creates political alarms, but various countries in Latin America and Eastern Europe have had periods when the annual rate of inflation was in 4 digits. Since money is whatever we accept as money in payment for real goods and services, there are a variety of other things that function in a way very similar to the official money issued by the government. Credit cards, debit cards, and checks are obvious examples. Mere promises may also function as money, serving to acquire real goods and services when the person who makes the promises is highly trusted. IOUs from reliable merchants were once passed from hand to hand as money. As noted in Chapter 5, more purchases were made in 2003 by credit cards or debit cards than by cash. What this means is that aggregate demand is created not only by the money issued by the government, but also by credits originating in a variety of other sources. What this also means is that a liquidation of credits, for whatever reason, reduces aggregate demand, just as if the official money supply had contracted. Some banks used to issue their own currency, which had no legal standing, but which was nevertheless widely accepted in payment when the particular bank was regarded as sufficiently reliable and willing to redeem their currency in gold. Back in the 1780s, currency issued by the Bank of North America was more widely accepted than the official government currency of that time. Sometimes money issued by some other country is preferred to money issued by one's own. Beginning in the late 10th century, Chinese money was preferred to Japanese money in Japan. In 20th century Bolivia, most of the savings accounts were in dollars in 1985, during a period of runaway inflation of the Bolivian peso. In 2007, the New York Times reported, South Africa's rand has displaced Zimbabwe's essentially worthless dollar as the currency of choice. During the later stages of the American Civil War, Southerners tended to use the currency issued in Washington rather than the currency of their own Confederate government. Gold continues to be preferred to many national currencies, even though gold earns no interest, while money in the bank does. The fluctuating price of gold reflects not only the changing demands for it for making jewelry, the source of about 80% of the demand for gold, or in some industrial uses, but also, and more fundamentally, these fluctuations reflect the degree of worry about the possibility of inflation that could erode the purchasing power of official currencies. That is why a major political or military crisis can send the price of gold shooting up, as people dump their holdings of the currencies that might be affected and begin bidding against each other to buy gold, as a more reliable way to hold their existing wealth, even if it does not earn any interest or dividends. Since the price of gold depends on people's expectations as regards the value of money, that price can rise or fall sharply and reverse promptly in response to changing economic and political conditions. The sharpest rate of increase in the price of gold in 1 year was 135% in 1979, and the sharpest fall in the price of gold was 32% just 2 years later. Existing or expected inflation usually leads to rising prices of gold, as people seek to shelter their wealth from the government's silent confiscations by inflation. But long periods of prosperity with price stability are likely to see the price of gold fall, as people move their wealth out of gold and into other financial assets that earn interest or dividends and can therefore increase their wealth. When the economic crisis of the late 1970s and early 1980s passed, and were followed by a long period of steady growth and low inflation, the price of gold fell over the years from about $800 an ounce to about $250 an ounce by 1999. Still later, after record-breaking federal deficits in the United States and similar problems in a number of European countries in the early years of the 21st century, the price of gold soared well over $1,000 an ounce. The great unspoken fear behind the demand for gold is the fear of inflation. Nor is this fear irrational, given how often governments of all types, from monarchies to democracies to dictatorships, have resorted to inflation as a means of getting more wealth without having to directly confront the public with higher taxes. Raising tax rates has always created political dangers to those who hold political power. Political careers can be destroyed when the voting public turns against those who raised their tax rates. Sometimes public reaction to higher taxes can range all the way up to armed revolts, such as those that led to the American War of Independence from Britain. In addition to adverse political reactions to higher taxes, there can be adverse economic reactions. As tax rates reach ever higher levels, particular economic activities may be abandoned by those who do not find the net rate of return on these activities, after taxes, to be enough to justify their efforts. Thus, many people abandoned agriculture and moved to the cities during the declining era of the Roman Empire, adding to the number of people needing to be taken care of by the government, at the very time when the food supply was declining because of those who had stopped farming. In order to avoid the political dangers that raising tax rates can create, governments around the world have, for thousands of years, resorted to inflation instead. As John Maynard Keynes observed, there is no record of a prolonged war or a great social upheaval which has not been accompanied by a change in the legal tender, but an almost unbroken chronicle in every country which has a history, back to the earliest dawn of economic record, of a progressive deterioration in the real value of the successive legal tenders which have represented money. If fighting a major war requires half the country's annual output, then rather than raise its tax rates to 50% of everyone's earnings in order to pay for it, the government may choose instead to create more money for itself and spend that money buying war material. With half the country's resources being used to produce military equipment and supplies, civilian goods will become more scarce, just as money becomes more plentiful. This changed ratio of money to civilian goods will lead to inflation, as more money is bid for fewer goods, and prices rise as a result. Not all inflation is caused by war, though inflation has often accompanied military conflicts. Even in peacetime, governments have found many things to spend money on, including luxurious living by kings or dictators, and numerous showy projects that have been common under both democratic and undemocratic governments. To pay for such things, using the government's power to create more money has often been considered easier and politically safer than raising tax rates. Put differently, inflation is, in effect, a hidden tax. The money that people have saved is robbed of part of its purchasing power, which is quietly transferred to the government that issues new money. Inflation is not only a hidden tax, it is also a broad-based tax. A government may announce that it will not raise taxes or will raise taxes only on the rich, however that is defined. But by creating inflation, it in effect transfers some of the wealth of everyone who has money, which is to say, it siphons off wealth across the whole range of incomes and wealth, from the richest to the poorest. To the extent that the rich have their wealth invested in stocks, real estate, or other tangible assets that rise in value along with inflation, they escape some of this de facto taxation, which people in lower income brackets may not be able to escape. In the modern era of paper money, increasing the money supply is a relatively simple matter of turning on the printing presses. However, long before there were printing presses, governments were able to create more money by the simple process of reducing the amount of gold or silver in coins of a given denomination. Thus, a French franc or a British pound might begin by containing a certain amount of precious metal. But coins later issued by the French or British government would contain less and less of those metals, enabling these governments to issue more money from a given supply of gold or silver. Since the new coins had the same legal value as the old, the purchasing power of them all declined as coins became more abundant. More sophisticated methods of increasing the quantity of money have been used in countries with government-controlled central banks, but the net result is still the same: an increase in the amount of money without a corresponding increase in the supply of real goods means that prices rise, which is to say, inflation. Conversely, when output increased during Britain's Industrial Revolution in the 19th century, the country's prices declined because its money supply did not increase correspondingly. Doubling the money supply while the amount of goods remains the same may more than double the price level, as the speed with which the money circulates increases when people lose confidence in its retaining its value. During the drastic decline in the value of the Russian ruble in 1998, a Moscow correspondent reported, "Many are hurrying to spend their shrinking rubles as fast as possible while the currency still has some value." Something very similar happened in Russia during the First World War and in the years immediately after the revolutions of 1970. By 1921, the amount of currency issued by the Russian government was hundreds of times greater than the currency in circulation on the eve of the war in 1913, and the price level rose to thousands of times higher than in 1913. When the money circulates faster, the effect on prices is the same as if there were more money in circulation. When both things happen on a large scale simultaneously, the result is runaway inflation. During the last crisis-ridden year of the Soviet Union in 1991, the value of the ruble fell so low that Russians used it for wallpaper and toilet paper, both of which were in short supply. Perhaps the most famous inflation of the 20th century occurred in Germany during the 1920s, when 40 marks were worth $1 in July 1920, but it took more than 4 trillion marks to be worth $1 by November 1923. People discovered that their life's savings were not enough to buy a pack of cigarettes. The German government had, in effect, stolen virtually everything they owned by the simple process of keeping more than 1,700 printing presses running day and night printing money. Some have blamed the economic chaos and bitter disillusionment of this era for setting the stage for the rise of Adolf Hitler and the Nazis. During this runaway inflation, Hitler coined the telling phrase, "starving billionaires," for there were Germans with 1 billion marks that would not buy enough food to feed themselves. The rate of inflation is often measured by changes in the consumer price index. Like other indexes, the Consumer Price Index is only an approximation because the prices of different things change differently. For example, when consumer prices in the United States rose over the previous 12 months by 3.4% in March 2006, these changes ranged from a rise of 17.3% for energy to 4.1% for medical care and an actual decline of 1.2% in the prices of apparel. While the effects of deflation are more obvious than the effects of inflation, since less money means fewer purchases and therefore lower production of new goods with correspondingly less demand for labor, the effects of inflation can likewise bring an economy to a halt. Runaway inflation means that producers find it risky to produce when the price at which they can sell their output may not represent as much purchasing power as the money they spent producing that output. When inflation in Latin America peaked at about 600% per year in 1990, real output in Latin America fell absolutely that same year. But after several subsequent years of no inflation, real output hit a robust growth rate of 6% per year. Deflation. While inflation has been a problem that is centuries old, at particular times and places, deflation has also created problems, some of them devastating. From 1873 through 1896, price levels declined by 22% in Britain and 32% in the United States. These and other industrial nations were on the gold standard, and output was growing faster than the world's gold supply. While the prices of current outputs and inputs were declining, debts specified in money terms remained the same, in effect making mortgages and other debts more of a burden in real purchasing power terms than when these debts were incurred. This problem for debtors became a problem for creditors as well, when the debtors could no longer pay and simply defaulted. Farmers were especially hard hit by declining price levels because agricultural produce declined especially sharply in price, while the things that farmers bought did not decline as much, and mortgages and other farm debts required the same amounts of money as before. An even more disastrous deflation occurred in 20th century America. As noted at the beginning of Chapter 16, the money supply in the United States declined by 1/3 from 1929 to 1933, making it impossible for Americans to buy as many goods and services as before at the old prices. Prices did come down. The Sears catalog for 1931 had many prices that were lower than they had been a decade earlier, but some prices could not change because there were legal contracts involved. Mortgages on homes, farms, stores, and office buildings all specified monthly mortgage payments in specific money amounts. These terms might have been quite reasonable and easy to meet when the total amount of money in the economy was substantially larger, but now it was the same as if these payments had been arbitrarily raised, as in fact they were raised in real purchasing power terms. Many homeowners, farmers, and businesses simply could not pay after the national money supply contracted, and therefore they lost the places that housed them. People with leases faced very similar problems as it became increasingly difficult to come up with the money to pay the rent. The vast amounts of goods and services purchased on credit by businesses and individuals alike produced debts that were now harder to pay off than when the credit was extended in an economy with a larger money supply. Those whose wages and salaries were specified in contracts, ranging from unionized workers to professional baseball players, were now legally entitled to more real purchasing power than when these contracts were originally signed. So were government employees, whose salary scales were fixed by law. But while deflation benefited members of these particular groups if they kept their jobs, the difficulty of paying them meant that many would lose their jobs. Similarly, banks that owned the mortgages which many people were struggling to pay were benefited by receiving mortgage payments worth more purchasing power than before, if they received the payments at all. But so many people were unable to pay their debts that many banks began to fail. More than 9,000 banks suspended operations over a 4-year period from 1930 through 1933. Other creditors likewise lost money when debtors simply could not pay them. Just as inflation tends to be made worse by the fact that people spend a depreciating currency faster than usual in order to buy something with it before it loses still more value, so a deflation tends to be made worse by the fact that people hold on to money longer, especially during a depression, with widespread unemployment making everyone's job or business insecure. Not only was there less money in circulation during the downturn in the economy from 1929 to 1932, what money there was circulated more slowly, which further reduced demand for goods and services. That, in turn, reduced demand for the labor to produce them, creating mass unemployment. Theoretically, the government could have increased the money supply to bring the price level back up to where it had been before. The Federal Reserve System had been set up nearly 20 years earlier during the Woodrow Wilson administration to deal with changes in the nation's money supply. President Wilson explained that the Federal Reserve provides a currency which expands as it is needed and contracts when it is not needed, and that the power to direct this system of credits is put into the hands of a public board of disinterested officers of the government itself, to avoid control by bankers or other special interests. However reasonable that sounds, what a government can do theoretically is not necessarily the same as what it is likely to do politically, or what its leaders understand intellectually. Moreover, the fact that government officials have no personal financial interest in the decisions they make does not mean they are disinterested as regards the political interests involved in their decisions. Even if Federal Reserve officials were unaffected by either financial or political interests, that does not mean that their decisions are necessarily competent. And, unlike people whose decisions are subject to correction by the market, government decision-makers face no such automatic correction. Looking back on the Great Depression of the 1930s, both conservative and liberal economists have seen the Federal Reserve System's monetary policies during that period as confused and counterproductive. Milton Friedman called the people who ran the Federal Reserve System in those years inept, and John Kenneth Galbraith called them a group with startling incompetence. For example, the Federal Reserve raised the interest rate in 1931, as the downturn in the economy was nearing the bottom, with businesses failing and banks collapsing by the thousands all across the country, along with massive unemployment. Today, anyone with just a basic knowledge of economics would be expected to understand that you do not get out of a depression by raising the interest rate, since higher interest rates reduce the amount of credit, and therefore reduce aggregate demand at a time when more demand is required to restore the economy. Nor were the presidents who were in office during the Great Depression any more economically sophisticated than the Federal Reserve officials. Both Republican President Herbert Hoover and his Democratic successor, Franklin D. Roosevelt, thought that wage rates should not be reduced, so that this way of adjusting to deflation was discouraged by the federal government, for both humanitarian and political reasons. The theory was that maintaining wage rates in money terms meant maintaining purchasing power, so as to prevent further declines in sales, output, and employment. Unfortunately, this policy works only so long as people keep their jobs, and higher wage rates under given conditions, especially deflation, mean lower employment. Therefore, higher real wage rates per hour did not translate into higher aggregate earnings for labor, and so provided no basis for the higher aggregate demand that both presidents expected. Joseph A. Schumpeter, a leading economist of that era, saw resistance to downward adjustments in money wages as making the Great Depression worse. Writing in 1931, he said, "The depression has not been brought about by the rate of wages, but having been brought about by other factors, is much intensified by this factor." It was apparently not necessary to be an economist, however, to understand what both President Hoover and Roosevelt did not understand. Columnist Walter Lippmann, writing in 1934, said, In a depression, men cannot sell their goods or their service at pre-depression prices. If they insist on pre-depression prices for goods, they do not sell them. If they insist on pre-depression wages, they become unemployed. The millions of unemployed, many in desperate economic circumstances, were not the ones demanding pre-depression wages. It was politicians who were trying to keep wages at pre-depression levels. Both the Hoover administration and the subsequent Roosevelt administration applied the same reasoning, or lack of reasoning, to agriculture that they had applied to labor. The price of farm products were to be kept up by the government in order to maintain the purchasing power of farmers. President Hoover decided that the federal government should give indirect support to prices which had seriously declined in agriculture. President Roosevelt later institutionalized this policy in agricultural price support programs, which led to mass destructions of food at a time of widespread hunger. In short, misconceptions of economics were both common and bipartisan. Nor were misconceptions of economics confined to the United States. Writing in 1931, John Maynard Keynes said of the British government's monetary policies that the arguments being made for those policies could not survive 10 minutes rational discussion. Monetary policy is just one of many areas in which it is not enough that the government could do things to make a situation better. What matters is what government is in fact likely to do, which can, in many cases, make the situation worse. It is not only during national and international catastrophes, such as the Great Depression of the 1930s, that deflation can become a serious problem. During the heyday of the gold standard in the 19th and early 20th centuries, whenever the production of goods and services grew faster than the gold supply, prices tended to decline, just as prices tend to rise when the money supply grows faster than the supply of the things that money buys. The average price level in the United States, for example, was lower at the end of the 19th century than at the beginning. As in other cases of deflation, that is, an increase in the purchasing power of money, this made mortgages, leases, contracts, and other legal obligations payable in money grow in real value. In short, debtors, in effect, owed more in real purchasing power than they had agreed to pay when they borrowed money. In addition to problems created by legal obligations fixed in money terms, there are other problems created by deflation that result from different people's incomes being affected differently by price changes. Deflation, like inflation, affects different prices differently. In the United States, as already noted, the prices of what farmers sold tended to fall faster than the prices of what they bought. The price of wheat, which had hovered around $1 a bushel for decades, closed out 1892 under 90 cents, 1893 around 75 cents, 1894 barely 60 cents. In the dead of the winter of 1895 to 96, the price went below 50 cents a bushel. Meanwhile, farmers' mortgage payments remained where they had always been in money terms, and therefore were growing in real terms during deflation. Moreover, payments on these mortgages now had to be paid out of farm incomes that were half or less of what they had been when these mortgages were taken out. This was the background for William Jennings Bryan's campaign for the presidency in 1896, based on a demand to end the gold standard, and was climaxed by his dramatic speech saying, "You shall not crucify mankind upon a cross of gold." At a time when more people lived in the country than in the cities and towns, he was narrowly defeated by William McKinley. What really eased the political pressures to end the gold standard was the discovery of new gold deposits in South Africa, Australia, and Alaska. These discoveries led to rising prices for the first time in 20 years, including the prices of farm produce, which rose especially rapidly. With the deflationary effects of the gold standard now past, not only was the political polarization over the issue eased in the United States, more countries around the world went on to the gold standard at the end of the 19th century and the beginning of the 20th century. However, the gold standard does not prevent either inflation or deflation. though it restricts the ability of politicians to manipulate the money supply, and thereby keeps both inflation and deflation within narrower limits. Just as the growth of output faster than the growth of the gold supply has caused a general fall in the average price level, so discoveries of large gold deposits, as in 19th century California, South Africa, and the Yukon, caused prices to rise to inflationary levels.